and welcome back to In Focus. I hope you're all having a wonderful week so far. This week, the Treasury released the long-awaited RBA review, a 294-page report outlining what the RBA, the central bank, should be doing to improve its governance, monetary policy, and general running. The huge report had been called for back in the Morrison government days, and over the last few years, it's been ramping up, particularly focused around what cash rate should be and how the RBA should be communicating it. To help me unpack some of this today, I've brought in the managing editor of Property and Financial Services, Phil Tarrant, to chat through all the findings of the RBA review. Thanks for joining me, Phil. How are you going?
Good, Annie. Thanks for having me on the show. I must admit, though, I haven't dug too deep into review yet. I try and avoid going through reams of government ramblings and bureaucracy. Sometimes I generally just like the executive summary. So that's typically how I like to do stuff. But it's good to see that there's more reviews underway to try and help us as Australians navigate the world ahead of us. But I must admit, I don't get too excited about this sort of stuff.
Well, thankfully I do, because someone has to. And I think this, for our area, the mortgages area, it has a huge impact. So I'll give you the headline findings. And I should caveat this by saying we're recording this a couple of hours after the RBA review came out. So this is very much initial reaction, but I'll give you some of the headline findings. So the key ones that I thought were really important were, firstly, the reviewers recommended that the RBA split into two boards. One which focuses on monetary policy, and a second board which looks at governance and how the RBA actually runs. So that's things like HR, risk management, the actual kind of running of the central bank, whereas the other one would be primarily focused on the monetary policy decisions. Now, of course, at the moment, that's different, because at the moment we have one board, 9 members, and the governor, Philip Lowe, included among them, looking at the cash rate decision, looking at monetary policy and what we should be doing to manage inflation and try and get back to the target range of 2 to 3%. What do you think about having two boards, Phil? Do you think it's a good idea, bad idea?
I think there's probably pros and cons to it. Already, I think a lot of decision making gets stifled by sort of the over bureaucratic wranglings of government. I'm very practical in my thinking, and I think the application of the role of the RBA in setting monetary policy. Look, let's just note that it is a very important function, and the responsibility of the RBA in getting it right is huge. You only need to think back a year or so ago, Annie, and a lot of property investors, and in my role, obviously, I work inside of property and real estate here at Momentum, working very closely with yourself in mortgages. A lot of Australians made investment and buying decisions based on the sentiment coming from the Reserve Bank of Australia and its governor that they would not lift interest rates until 2024. A lot of people are now struggling as a result of that. Now, the Reserve Bank will come back saying, well, you should borrow within your means. And there's obviously the rigors and regulations around responsible lending. If people have taken on too much debt, they need to be responsible for that. I know, and I acknowledge that. However, if we're here to make decision makings based off what we're being told by government bodies, you would think that you can make confident decisions. Now, I think a lot of Australians, a big wake-up call, and there's a big question mark now around the efficacy of the Reserve Bank of Australia. I'm not here to beat up the Reserve Bank of Australia. I know they do a very important and challenging job. So the notion of turning it into two boards, I don't know, how is the left hand going to talk to the right hand, and who ultimately is responsible for the outcomes of effective decision-making on behalf of the RBA. Now, if it's the Reserve Bank of Australia's job to set monetary policy, and the setting of monetary policy is connected in with the economic health of the nation and the wealth effect connected in with that, I think all Australians feel richer or poorer every single Tuesday when the Reserve Bank comes out and tell you what it's going to do. So I want to know who's going to be accountable and responsible if you have two boards. Who ultimately is going to say, yes, we got it right, and yes, we got it wrong. Now, you're talking about the mechanics or the machinations of setting monetary policy under one of those boards, and then you've got the oversight and the governance and everything connected in with that. Now, if you look at the parliamentary system in Australia, we have two houses. We have a House of Representatives, and that's where new ideas are debated and policies created, and then it goes over the Senate, and the Senate says yes or no. Seems to work okay in that regards, and maybe that's what they're channeling. Annie, as I mentioned, I'm really light on the facts of this report. It's only just come out.
Yeah.
And I'm thinking straight off the cuff, like maybe they're looking for some clues there. But how is that going to work? And if and when they get it wrong, and I tell you what, they will get it wrong because that's just the nature of the beast, who's going to ultimately put their hand up and say, yeah, it was us?
Well, this is actually the really interesting point. So Philip Lowe did a press conference immediately afterwards, well, around midday, so a couple of hours after the report came out. And he was saying, a lot of the time I'm held personally responsible because when the minutes come out, when we have our board meeting on the first Tuesday of the month, for every month apart from January, he was saying, my name is at the end of it. But it's actually a board decision. He's like, it's just me delivering the news, but the board actually makes the decision. He's like, a lot of the time it's a team decision, but I shoulder the blame. And obviously as governor, he has to have some sort of responsibility and he's the key person there. So he has to have, really, at the end of the day, it's his sort of say, but it's a joint decision. I think having this secondary board, which just focuses on monetary policy, will be pretty interesting. And the reviewers were saying it shouldn't just be RBA people who are, historically lawyers or historically economists. It's like it should be people from other walks of life as well that are involved here. So people with, business finance experience. So it could be we see some former bankers on there. It could be that we see some property people in there, or maybe even in some respects, business people.
Are you lobbying for a seat on the board, Annie?
Yeah, I'll come along. No, thank goodness. It would be terrible if I was on the board of the RBA. I have no idea what I'd be doing. I'd just be like, what do you think? Yeah, good idea. So I think that generally what they're sort of looking at is saying, well, let's have this board be really sort of, I suppose, more egalitarian. So they're saying not only should they have this board decision, but also the board should front the media after the rate decisions. The commentary that comes out after the rate decision should be from the board to try and, I suppose, alleviate some of that personal vendetta that people had against Philip Lowe. Of course, when he said in 2020 that they wouldn't be moving rates until 2024, that language tweaked a little bit in 2021 when he was saying, we still expect target inflation to be a while off and we're going to keep on reducing or holding rates where it is at 0.1% until 3 years' time. So that obviously is what you're referring to there with the pain that people felt. And I've heard Philip Lowe previously say that he's been, he's had people write to him. He's had people outside his house saying how much pain they're in because they took his forecast as law. Now, we should always caveat this, I think, by saying he wasn't to know that the Russian-Ukrainian war conflict was going to take place. So, of course, that had a huge impact on inflation, which pushed it up dramatically and then eventually led to the decision in May 2022 when inflation was high, when cost pressures were there, when the Ukrainian war was having its impact. That led to the decision in May 2022 to increase rates 2 years before expected. But tough. The other recommendations, sorry, go ahead, Phil.
No, it's really tough. And I'm conscious about the role that Dr. Lowe plays. I reckon it's the hardest job in Australia in many ways, and often thankless. Everyone loves you when interest rates are really, really low and everyone's getting cheap mortgages at 2%, and making decisions around that. Riding on the coattails of a COVID recovery and the rapid acceleration of property prices in Australia and the inherent wealth creation effect as a result of that. Happy days. As soon as you start putting rates up, you're the most hated man in Australia, or the most hated person in Australia. And the fact you got to do it, was it 10 consecutive times, 10. Annie? There's been rate rises. You're not going to be well liked. So I've defended the RBA and a lot of the commentary I've been having around it when people have been, talking about this notion of, Australians have gone about making investment decisions, buying decisions, life decisions around lower interest rates. The problem, and I doubt he or anyone who will come subsequent to Governor Lowe probably won't again say we're going to keep interest rates at this point in time for a period. I reckon there's a big lesson out of that, and I think everyone will appreciate that. We're probably going to hear that rhetoric again, up or down. No one's ever going to go, I think we're going to be at this interest rate by this period of time, so everyone will scramble and go and make decisions around it. Lesson learned. But it's a very fluid and a very vibrant situation that the decision making of the RBA has to take into account. I'd say that's manifested most recently in this upward cycle, which is largely unique. You're running off the back of the COVID-19 pandemic, and to your point, early last year, Russia invaded Ukraine, which only augmented the considerable supply chain challenges that the world was facing at that point in time. Now, a lot of that has been ameliorated with China's economy coming back online, still disrupted, which has given some relief to inflationary cycles, the inflationary cycle. However, the war in Ukraine will continue for a for a significant period of time. So there's a huge uncertainty there. Now we're at this point of time now where the Reserve Bank has decided to pause interest rates. We're recording this in April. Now I note, Annie, and I don't know what your view is. I have a bit of a view on it. Is that enough in terms of interest rates? You know, how is this decision making going to take place moving forward? Now you talk about this review that's underway. I don't know the time horizon of these changes that may come into place based on this. Now I heard very briefly, I'm scrambling to try and get the information. I saw a piece come through from our good friends over in Lawyers Weekly, I think, saying that a former federal court judge has now been appointed to the Reserve Bank board. I hear that they're talking about only meeting 8 times a year rather than the 11 they meet right now. Have I got that information correct, Annie?
That is correct. So two board members appointed, both Ian Ross, who's a former judge, a former federal court judge, and also Alana Rubin, who was the chair of Afterpay. They've both been appointed. Now, this is one of several appointments that we expect to see coming up, because they are suggesting that we get 2 more additional board members. So these 2 that are currently being appointed
are replacements. Splitting the board or the same board?
This is, when we split, we expect to have 2 more. So the Monetary Policy Board, the governor will chair, and this will be the only board that he'll chair. And it will also have in that board the deputy governor, as well as the assistant secretary, treasury, and 6 external members as well. Now, the current 2 appointments, Ian Ross and Alana Rubin, are for existing members. They're replacing existing members whose tenures have finished, but we do expect to see 2 more being appointed as well. So,
and when would that construct take place, if it were to take place?
Most likely next year. So a lot of the overhaul.
I'll learn on the spot, because you've obviously reviewed it really quickly. So have they said this is actually happening, or we're thinking about this happening? So
Treasurer Jim Chalmers has said we'll in principle adopt all 51 recommendations from the review. Some of that, though, requires legislative changes. And this is why it's going to take a little bit of time before we actually see these changes come into effect, because they need to go through the regulatory process, the legislative process, which takes a long time. So Treasurer Jim Chalmers is pretty diplomatic in saying that he'd obviously given the review to the Shadow Treasurer, Angus Taylor, as soon as it came out. He's been working really closely with him, because it does require bipartisan support.
So it is bipartisan initiative. Is there any pushback from the coalition government?
I don't think so that I have seen yet, no. And Angus Taylor was saying, we think the RBA is great, but we could have some improvement. And that's a very similar rhetoric to Jim Chalmers saying, they've done a great job the last 30 years. It's time for some improvements. So I think the thing, though, around the frequency of the meetings is really interesting. So going from the current situation where we have 11 cash rate decisions on the first Tuesday of every month, apart from January, shrinking that down to 8. Now, that's a pretty interesting move. And the reviewers said that really what they think would allow for, and this is a quote, more in-depth discussions, including of the forecast strategy and other monetary policy issues. They want them to really look at a lot more reports, talk to a lot more economists, generally have a lot more consultation around what is happening in monetary policy, and therefore only have 8 cash rate decisions, which happens in other jurisdictions. Like I think the UK only has 8.
Okay.
I don't know how I feel about that, though. I'm a bit like, I think I quite like the consistency of 11. It means that you kind of know where you're going each month. You don't have to keep track of, is it an RBA month? Is it not?
It's a really tough one, and I haven't yet formed a view on it. But I look to other recommendations that come out of government. If you only think back, Annie, and you're at the helm of the advisor at the point of time when the most recent Royal Commission around which wrapped up mortgage brokers, everyone came out and said, yes, we're embracing every single recommendation. And everyone went, well, hang on a second, including all the ones about changing broker commissions, and the industry, including the advisor, got behind that. And a lot of those that sentiment about embracing all those changes, it was turned on its head, right? So they might be saying that now. I reckon once industry and invested stakeholders get stuck into this, the mechanism of lobbying will start. I don't know where and how and where that will come from, but this idea around 8 interest rate decisions or meetings every year rather than the 11. So what? Okay, so this is actually, so what? What does it mean? So does that mean there'll be less chances for them to move on rates, and when they do move on rates, upwards or downwards, they'll be in aggregate bigger? Now, if you look at this current rate cycle that we're in now, pulling back to inflationary pressures. The idea, and there's always been this rhetoric that the target inflationary range for Australia is somewhere between 2 to 3%. That's not going to be that for Australia for the short to immediate future. Chasing 2 to 3 target range is unrealistic in this environment, and it will take years for us to get back to that range, purely because of this hangover legacy of the current environment that we're in right now. It's going to take that long to wash through. Yep. So, trying to restructure for the purpose of chasing a 2 to 3% inflationary target, the timing doesn't work for me as it sits right now, and a lot of thinking needs to go into that. I think, and I spoke with a regular commentator, you see him on The Advisor, Mark Burris, about a month ago, I think, and his logic was the target range for inflation should be thereabouts what the increase in jobs are, in salaries are every single year.
Wage inflation, yeah.
And then you're sort of stuck between this thing: is that regulated, unionized industries or government departments which have quite structured pay reviews, or is that more of the business environment where capable, talented people rise through the ranks quickly and typically get bigger pay rises, right? So where that lives, I don't know. I tend to subscribe in with his thinking, and I think that will probably set the inflationary target and therefore range for Australia for the next period of time. And I reckon it's probably going to be somewhere around sort of 4 to 5, maybe a little bit more %. And that's going to be our future moving forward. Now, using interest rates as a mechanism for shaping that is very difficult. Maybe if you've got a direct board whose job it is to just hone that and concentrate on that and have longer to work it out, i.e. 8 times a year rather than 11 times a year, that may have its merit. But again, it's a really tough environment for these operators inside the Reserve Bank to work within. Now, we accelerated on 10 interest rate rises really quickly with a break over January because the Reserve Bank didn't meet. It's hurting Australians' hip pockets right now. We're probably at maybe the top of that cycle. We might go one more, who knows. I just can't see too much change. They've decided to pause interest rates now so they can actually let these decision-making breathe. Now, coming back to 8 rather than the 11 that they do right now, it might actually structurally allow this notion of any changes to interest rates. We give it more time in the market to work out whether or not it's taken effect. So I reckon they're buying themselves time by doing that, which should help with their decision-making, whether or not they need to go up or down, move forward. Now, if you had 2 or 3 months, and they said this over the break period when we didn't meet, the Reserve Bank didn't meet in January, they went, at the end of December, all the stuff that we've done from May to December, we can actually see now whether there's any change in spending habits and the inflationary pressures. And they moved again in February, they moved again in March, and now we're a pause in April. So giving the Reserve Bank more time to see the impact of monetary decision-making by doing 8 times a year, I think that has merit. Do we really need to? You can't change too much stuff in 30 days. You can't change it. Let it go 60, 90 days to see cause and effect. Has it stopped stuff? And I reckon what's happened is that they've given a pause in April. Let's see if it works out. Let's let it breathe a little bit. I reckon that might extend out to May as well. They'll go, let's try this idea of 8 times a year and give 2 months, good solid 2 months structurally, so we don't need to rush with our decision-making. Bad decisions are made if they're rushed. And if you're making on the immediacy of decision-making without seeing the actual impact of that, is when you can just exacerbate these problems moving forward. So as I think about this, sort of debriefing with this myself, I'm all for the 8.
Okay, good. Well, I think
I'm all for the 8 now. I've worked it out myself.
You've got that.
Give them time. Because me personally, and I think organizations, you can have an idea, but don't rush the decision-making process. You've got to let things percolate, right? You got to actually wait to see whether the impact of what you're doing is taking effect. It's very hard to do that monthly.
I think there are a couple of things that you said there I want to pick up on. So, obviously the flow on effect to the back pocket, that's an important one. So the delay, we know it takes, a couple of weeks for the banks to actually change the rates. And then it takes a while for the repayments to actually come into effect as well. So even after the banks have announced, it's normally
the only person that
after.
wins on a rate rise is Australia Post, right? Because they get they get to send all the letters out to every single, and if they keep doing that, every single month they've had a nice paycheck from the banks, right, to do that.
Lovely. But I think the other thing is not only for giving it time to breathe for consumers to be able to catch up with their repayments, to see what that effect is and how consumers are spending, but also because there are lots of data sets that the RBA use when they're making their cash rate decision each month that aren't available monthly. So the CPI, the Consumer Price Index, is quarterly. That's the main one they look at when it comes to inflation. They did recently start doing a monthly series because they were like, well, we actually need more up-to-date information if we're going to be doing these rate decisions every month. So that they kind of still focus on the quarterly CPI figures, because that also, helps take out things like, Black Friday, for example, in November, or Christmas in December, or summer holidays in January. There's always something happening where it kind of can impact a monthly inflation statistic to sort of skew it one way or another. So the quarterly ones are a bit more balanced, but also because it enables them to see what other jurisdictions are doing. And I gave them the example of the UK, the US as well. A lot of our central bank policy decision makers really work very closely with their central bank counterparts. And so having the ability to talk to the UK or the US when they've changed rates, which is less frequently than we do, and talk about why they've done that, that might also help if we can align all of our sort of rate decisions to be similar. But Philip Lowe did say in the media briefing immediately afterwards, he was saying, I actually don't really mind having 11. I like catching up with our board members 11 times a year. It helps us keep track of things. It helps us, think about policy. Yeah, they just don't need to tell us. Yeah.
But they just again, it comes back, and the more I think about it, Annie, I'm for it, because you made two very important points. And I spoke about, if you move to 8 rather than 11, it gives the Reserve Bank more time to be more decisive in their decision-making, cause and effect. Make some decisions, see how it plays through, wait, see, do you need to do more up, down, left, right, whatever it is. That makes it, but you made the important point, be much better for consumers. So if you have uncertainty about, is my interest rate going to go up again? Now, it's really, really hard for consumers also. If interest rates are going up, it's very hard to recalibrate your family balance sheet, your family expenses on a month-by-month basis. If you have 3 months to do that, it's got to give you more time to ameliorate some of the impacts around rising interest rates. So you're not every single, okay, I've tightened my belt for this month. Okay, I've brought my expenses back again. Oh, well, I've got to do it again this month. Bang, bang. It's going to go to a point where you can't do too much more. So if you give consumers more time to absorb the impact of interest rate rises, I think it's a lot more positive, because it's fatiguing if you have the uncertainty. Think about it, Annie. The uncertainty for a lot of Australians who are already redlining on their interest repayments right now, not knowing what's going to happen next month, not knowing what's going to happen next month. If you give them 2 to 3 months, and I don't know the cadence of when those 8 would happen, that's going to be much easier for them. And I do note also around timing, it takes largely 3 months for property price data to actually end up in the hands of people. So we're recording this in April right now. So that the April numbers we have in this business and everyone else gets from CoreLogic is what happened in January. That's when we get the data. And the same applies to all this the stagnant nature of data coming through to decision making. Now, if you've got on the ground sort of truth as in what's happening right now, hence the reason why auction rates are a really good tempo for what's happening in real estate. That's why people are so dialed into it every single week. But it takes 3 months, largely 2 to 3 months, to actually get the real data about what happened that long ago. Now, if you allow the Reserve Bank longer to make their decisions so they can absorb all of that data around it. Now, let's be clear. And I remember when you were heading down to, you went to a press event and you sort of asked the Reserve Bank governor a question. We spoke beforehand. You said, what would be the question that you would ask him, Phil? And I didn't ask him that, yeah. And I said something along the lines of going, how much impact I can't remember. It's like, how much impact do you think your decisions have on property prices and the financial happiness of Australians? And you said, there's no way in the world is going to answer that stuff. And I get that, right? But that's what this is. That's what this is. Interest rates, you're probably familiar with the term, the Canberra bubble, Annie, and that is like people who in Canberra are so absorbed with politics, right? The rest of Australia doesn't really care. So they call it the Canberra bubble. There's his own little world where heightened emphasis, and you think if you operate within that everyone is so connected in with it. The same is within the interest rate bubble, right? Like we're journos, we work inside and around finance. We're absorbed with this. We're inside the interest rate bubble. We think this is so important to everyone, right? Where it is important to everyone, interest rates is the dramatic impact, positive or negative, on the health of Australians' finances. Can they afford to live? Do they have extra money? And what are they doing that? If they've got extra money, guess what? That goes into the economy, it stimulates activity. If they don't have extra money, stifles the economic growth. Hence the reason why they're trying to raise them right now to slow everything down. So interest rates do matter, Annie. They do matter. And therefore, 8 times a year rather than 11 times a year, we need longer for decision makings to take place. And that's going to be the policy I move on from here, unless someone tells me otherwise. I'll probably say something else next week. Don't worry.
I like coming into it, you didn't have a view, and now you've already formed one and it's very firm. Let us know what you think, whether you think 8 meetings is a good idea or whether they should stick to 11. I'm on the fence. I understand that 8, it might make the data sort of reasoning a bit easier, but for 11, I've just got used to it.
To be fair, I reckon 11 is okay if you're all-time low interest rates.
Yeah.
So 11 doesn't become okay when that starts going up every single month, right?
Yeah, and I should just talk about the other recommendations. To say there were 51, so there's lots. Some of them are really boring. They're just about repealing defunct or sort of relic legislation that no one's ever heard of or no one's ever touched.
Less legislation is good.
So removing some of the laws that just are superfluous now, like, for example, there's a lot of laws in place or a couple of laws in place where the RBA has some control, and that's because the laws were put in place before APRA came around. So, there's sort of things like that are being repealed. But one of the things that I did think was interesting is that the reviewers said, we think that the cash rate should still remain the primary tool of monetary policy, but they should also consider to use other monetary policy tools when the cash rate cannot go any lower. And I think that's obviously a key learning from the pandemic, being like, we had these emergency low settings of 0.1%. We had that for such a long time and nothing else really could be done. So it's talking about what else can there. So they were saying, it could be better consideration of costs and benefits, risk analysis, exit planning, generally just deploying different tools around what can the central banking system be doing other than just changing the cash rate, because of course the cash rate mostly impacts mortgages, and therefore you have to be owning a property to be impacted, or conversely saving and then seeing the converse of whatever it is that's been.
You got to remember the construct of the Australian property market is that there's a third of people rent, a third of people own their own home, and the other third of people own their own home and have no debt on it. So there's people that own a home, have debt on it.
Lucky devils.
The other third don't have debt on it. So messing around with interest rates for those people who own their own home without debt on it, typically older Australians who typically have better financial strength, the cost of living might impact them a little bit, but they can largely weather the storm as the other two people who get impacted by interest rate rises. And typically it's aimed at mortgages, but there's also the other lending. Business lending is impacted by interest rates. Commercial property is impacted by interest rates, and also how people invest in other asset classes, and also the notion of the liquidity that revolves around that and how liquidity follows different asset classes depending on what's going on, right? So they're really, really important, interest rates. But to your point, when interest rates are really low or interest rates are going high, you're messing around with that too much. I think it sort of largely works, whether or not they move into 2 boards, monetary policy and a governance one, who knows? But what we need to remember is that we have this thing called APRA, and APRA can be a really good functional tool for shaping the way in which lenders make credit available to Australians. And you only need to think, Annie, everyone's saying interest rates are going up, so why are they maintaining this serviceability buffer on mortgages at sort of 3%, right? 3%. Within sort of the major banks. So they're saying, well, when interest rates are all-time low, banks were putting 3% on, it was 2.5, then 3% on top of the standard variable rate to assess people's serviceability. Now interest rates are up at, sort of headline rates of 6%. You still got 3% on top of it. So you're assessing people at 9%, sometimes 10%, right? Well, you should bring that down because interest rates are pretty much at the top of this rising rate cycle. And APRA said, no, we're not going to do that. We're going to leave it there. And I think that's smart, right? But it's a blunt tool. And if you only think back, and what should be happening is this nice relationship between monetary policy setting coming out of the Reserve Bank of Australia and how they choose to use APRA. I don't think they need to include new things. I reckon they could just use that more appropriately for curbing or on alternative that motivating people's ability to access finance. And that's what it's all about. I think Australians are a lot more responsible about this right now. And it's codified in how they receive finance. There's responsible lending requirements coming out of, best duty stuff and all this sort of thing. Use APRA more effectively as a practical mechanism for shaping access to credit, rather than over scripting or being over bureaucratic in how the Reserve Bank actually functions, is one view to have on it. Annie, I don't know what your thoughts are on this 3% buffer or so. I reckon they're going to keep it there. I reckon it's smart business.
Yeah, they reviewed it a few months ago and they said we're pretty happy with where it is. The other, when they were looking at what else they could do, there were other conversations around debt to income ratios and whether we should be reviewing that. I think 3% at the moment seems high, but as I say, if you look in other jurisdictions like Europe and America, their banking system is having a lot more strife than we are. And part of it is because we have quite high regulation. We have quite high liquidity ratios. The banks are quite highly regulated. There's quite a lot of capital they're required to have. So I think generally the way that APRA functions is conservative with a small c, but it has sort of protected us from some of the issues that have been faced overseas.
You look back, you got to score them pretty well. Don't always get everything right, but look at the inherent health of the banking system and just how integral that is to the economic prosperity of Australia. The global financial crisis was tough times. Australia did pretty well.
Yeah. I want to just quickly, Phil, just touch on one of the criticisms that the RBA reviewers had of the RBA. And I thought this was really interesting. So this goes to a little bit around the additional board members we were talking about earlier. So they said, currently, the Reserve Bank Board provides only limited challenge to the RBA executive's view, and its skill set is not matched to the complex and uncertain economic environment in which monetary policy will increasingly operate. The external members of the board have been outstanding leaders in their fields. However, collectively, they have less economic and financial market expertise and spend less time on monetary policy than decision-making bodies at comparable central banks. Monetary policy involves making technical judgments and important trade-offs in an uncertain environment. Combining the judgment of a group of people with deep and relevant expertise provides the best chance of achieving good outcomes. The review seeks to raise the collective economic and financial expertise of monetary policy decision makers while recognizing the importance of retaining diverse perspectives and knowledge. So they're saying, talk to other people, don't just talk to the RBA people, because we need more knowledge base here. We need more people coming in from diverse backgrounds, diverse industries, informing what the central bank does, because of course central bankers can sometimes, as you mentioned about the bubble earlier, be stuck in maybe their central bank bubble.
There's absolutely a central bank bubble. It sounds like to me they're saying that maybe the people they've got, maybe the people that they've got inside of the RBA doesn't give a holistic view of
society.
It's not saying they're not smart enough, but I think it's more of an experience orientation, as in they're experienced doing one thing, but they need to open it up. Now, the challenge you have, though, is that you can't have a board of 100 because it stifles decision-making, right? So I guess the opportunity is that how do they get more organic information, feedback, intelligence to shape the more formal decisions? Now, in principle, that makes sense. And I get that. And I think good decision-making embraces a whole bunch of ideas, but you can't over construct that. You can't make it too bureaucratic because it just stops decision making happening. So, I imagine what you'll see is all these new committees will be created in different industries to help shape that decision making. Good in theory, I reckon very hard to do in practice.
Yeah.
Now, what do? Get 100 people from the mortgage industry and ask them what they think about stuff. Then someone's got to try and curate into a number of ideas which can be taken to the board, and when they're making considered decisions, going, this is what we hear from the mortgage industry, this is what we hear from the legal industry, this is what we hear from the defense community. Tough. Yeah. It's a tough job.
I think it'd be more like having people from, for example, the infrastructure community, maybe looking at what projects do we have in the pipeline as a nation, what kind of, are we building massive train lines? Are we building a lot of buildings? What kind of construction do we have? As well as just looking at the financial side of things, looking at sort of, what's happening on the ground in the actual economy of Australia and help that feed into the narrative too. But yeah, lots of fascinating stuff in this review. As I said, we've only really had a couple of hours to read it and listen to Treasurer Jim Chalmers, who, as I said, has said he'll recommend that the government he'll adopt all 51 recommendations and work through with the opposition on getting some of those legislative changes in place so they can change what the RBA does. Philip Lowe has said, he'd be up for a second term. It's not up to him if he continues his tenure as governor past September, which is
that
when
what
it
he said?
expires. Yeah, he said, if they want me, I'm up for it. But we'll have to wait and see. I'm not sure if Jim Chalmers will keep him there. I think we'll have to wait and see what the economy is doing, and Jim Chalmers has said they'll review his position in the middle of this year, when generally they're expected to. So I think sort of June, July time. That will be firstly after the budget, which is obviously taking up Treasurer Jim Chalmers' time at the moment.
Other public service leaders have had their terms extended when normally they would have been terminated. So there's some clues in that.
We'll see. He's been governor for 7 years. Whether he continues to be is up to government. And I think they'll be obviously consulting with a lot of people around what should be happening here. I think given what the RBA review suggested, it sounds like change might not be a bad thing. They're kind of saying we need a bit more new blood coming in, a bit more challenge to the governor's views, not necessarily Philip Lowe's, but the governor's views. And I think, he probably could do with a holiday himself as well.
Maybe, and it goes back to the point, right? Been tough. You're trying to sell bad news to Australians every single month. That's hard work, right?
Yeah.
So, and you got to, in many ways, they're very difficult jobs and sometimes thankless jobs, because no matter what you do, you cop so much criticism, and that's how it works inside a government or the public service. So, you got to acknowledge the good and trying work that these government people do. Like, you got to say thanks, even though you might not always like the decisions they make.
Yeah. And of course, I mean, when I spoke to Philip Lowe the other day, when you were referencing the National Press Club meeting, he was saying, he defended the consecutive cash rate hikes, and he's like, there are two options really. It's increase the cash rate or see unemployment rise, because obviously businesses will struggle. So he's a bit like, we didn't really want unemployment to rapidly increase, so we went for the cash rate route. So interesting to see. I should mention just quickly an overview, some of the other areas that the recommendations touched on. So the first one saying monetary policy generally is fundamentally sound, but should be more clearly defined and regularly assessed for updates. Monetary policy decision makers should be strengthened, drawing on more expertise and with processes that promote deeper contestability of ideas. That's what we've just talked about. The RBA should become more open and dynamic through new internal structures and approaches. Now that goes to the governance side. And then fourthly, the RBA's corporate governance should be strengthened with contemporary governance structures that better manage risk and drive change. So again, a lot of that looks at diversity and actually providing a bit more overview in the governance structure of the RBA, the central bank itself. So lots to get through there, but yeah, I think generally.
Thank you for the executive summary. That's it. I'm informed.
Yeah.
This is why I read the Advisor every day, Annie. I look forward to the coverage you got coming out on it.
Yeah, thank you. Well, I mean, we've got to do a lot of transcribing quickly, but yeah, Philip Lowe, I think generally was like, we welcome the review. He had some issues with how the board, or how he, I suppose, was presented, saying the board is the people making the decision. It's not just me. And he was saying, I think there's plenty of experience here. So obviously defending the board there. But saying, yeah, he'd be keen for a new term. Treasurer Jim Chalmers saying they'll take all the recommendations forward. Couple of years, I think, before we start seeing all of them done. So I think he was saying sort of mid 2024, we'll see most of the recommendations implemented. Obviously, that takes legislative process. So hopefully everything gets through Parliament okay. And lots to get cracking on with in the meantime, because we're entering a new financial year and a new economic environment. People starting to look very closely at slowing down growth in the next few months, what's happening in other markets like America and Europe in their banking system, what's happening with supply chain issues, what's happening with inflation. So generally a little bit of concern about how strong the economy will be in the next few months. So watch this space. There's lots to keep track of, but we'll obviously try and bring you as much news as we can on theadvisor.com.au. Phil, thank you so much for joining me.
Yeah, good. Well, I hope you invite me back. And I always like talking about mortgages and real estate. And I really like your background, by the way. It's nearly as good as mine.
Snap. Yeah. If you've got any questions for me or for Phil, then do feel to reach out. You can reach me at editor@theadvisor.com.au, and Phil Tarrant, the managing editor of property and financial services, can be reached at editor@realestatebusiness.com.au. Do also take a listen back to previous episodes on the Advisor Podcast Network for our Elite Broker series, as well as other In Focus podcasts looking at different themes in the Australian mortgages market. We hope you all have a fantastic week, and we'll catch you next time for another episode on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Okay, let's do normal one, and I'll see how it works.
Normal voice? Okay.
Yeah.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.